Hey guys, welcome back to the channel. It's Henry. In today's video, I want to talk about selling options and the wheel strategy. I think the wheel strategy is one of the best strategies for consistent income, and specifically the wheel is actually safer and lower risk than pretty much every single other strategy out there. The wheel is actually a very good system that you can implement because there's not that much you have to do. With the wheel strategy, I'm going to be showing you an example of just selling puts and then selling calls. You automatically sell puts and then you automatically pick a strike and you sell calls as well. It's a very awesome system. It's safe, it's low risk, and I'm going to discuss how it works. The example that I'm going to be using is PLTR. I have a sizable position and long track record of success with the options on this stock. Let me explain to you how the wheel works on a deep level, step by step in this guide with examples. Before I jump in and flood your pockets with money, make sure you smash that like button for Uncle Henry and subscribe to the dopest YouTube channel out there about option trading. So this strategy is truly going to change the way you think about generating income through option trading. Best of all, you can enter a stock and reduce your cost basis down to eventually $0 for a stock. Here's the steps to running a successful wheel strategy before I show you a visual example. Number one, pick a stock. Ideally, you like this stock because it will make running the wheel strategy so much better, because when you eventually get put the stock, you will not mind owning it anyways. Number two, sell a cash covered put. We write a contract that someone else buys. When they buy the contract, we agree to buy 100 shares of stock that we choose in the case that the stock actually falls under a strike price that we determine ourselves. So we have so much control with this strategy. In return, the buyer of the contract pays us a premium, which is just money in return for the contract. It is up to you to find that boundary, but generally, if you want an option to be worth your time, your premium should be at least 1% of the stock's price. Now you just repeat this every week until you get assigned. Step number three is where the wheel becomes the wheel. Once assigned, you sell a call option. We write a contract that someone else buys. When they buy the contract, we agree to sell 100 shares of the stock that we own in the case that the stock goes above a strike price that we determine. In return, the buyer of the contract pays us a premium, which is just the money in return for the contract. I'm going to give you a very good visual explanation so you can understand this better, but I bet now you can see why it's so powerful and easy to run the wheel strategy and make a lot of profits. You can keep pocketing the premium every time one of your contracts expires worthless and build this up into a large portfolio. Let me share my screen with you guys and give you some real numbers and examples. All right, so now I'm going to show you how the PLTR wheel strategy works, and today specifically the stock is up 10%. So I made $10,000 today on the stock, and I've also made $6,000 total return on the options and $851 on the options just today. So overall, I am absolutely killing it on PLTR. I want to show you how you can do the same thing. All right, so go to trade PLTR options, and what you want to keep in mind is you want to look out for any support and resistance lines on PLTR. Right now, given its 10% rise, I would say that the stock is in a bull trend right now, and the wheel strategy is going to make sense. So to start off the wheel strategy, you go to sell, and then you go to put, and now I'm going to show you how I'm going to pick the strike, how I'm going to manage this position from A to Z. So first of all, I want to sell a put option, and this put option will go into about 45 days until expiration. Now look, you can go shorter term expiration, and I want you to be very understanding here. If you go shorter on the expiration, you have more work to do. If you go too long in the expiration, then there's not much work to do, but it's just not optimal. So for me, the expiration date that I like is anywhere from 1 to 6 weeks. So this would be at the top of my range, or the longest to expiration date that I would pick. Now, what I'm going to look for is I'm going to look for a slightly lower delta, around 30, all right? So you can see right here that the delta on this 25 sell put option, my intuition already told me that it's going to be around 30. Delta here is 0.32. The volume is 1,900 shares. That's actually very good. That means that a lot of people are trading this option right now. So these are the two things that I look at, as well as the bid-ask spread. Now listen, this is super important. If you're trading PLTR or any other stock, it doesn't really matter. I just want you to understand on a deep level how to use the wheel strategy and how to profit off of this strategy, because I've been able to retire essentially on just this strategy. You want to go for stocks and you want to pick options that have a tight bid-ask spread, because when this is not tight, when this is like very far apart, that means it's going to cost you a lot of money. So right now, if if I click this option, I go to continue, you'll see that the bid and ask is very, very close to each other. That's a really good thing. That means there's a lot of liquidity. A lot of people are obviously trading this stock, and that makes it very profitable for you to get in and get out. Now look, when I sell this 25 put option right here, that's essentially going to give me the obligation to buy Palantir stock below 25. What does that mean? Well, that just means that if the stock goes down, I will be forced to buy it, but that is okay with me because I want to own Palantir at $25. So I'm actually going to be getting paid $125 here in terms of premium, and that's if I get assigned on Palantir. So if I end up getting assigned, if it goes below 25, even if it goes to $24.90, you will still be assigned. You get assigned at anywhere under $25, and you won't be assigned early. You don't have to worry about that, all right? So you won't be assigned early. You'll be assigned closer to September 20th at expiration. It doesn't really make sense for people to exercise options early because then you just lose out on the time value of the option. Plus, just so you know, if you do get exercised and assigned the shares, that's also absolutely nothing to worry about because this is a bullish strategy. I am selling puts and I'm running the wheel strategy only on stocks I like. That is mandatory for me. I need to pick stocks that I enjoy. So on Palantir, I would sell a 25 strike price right here. Now, I want to talk about what you do once you do get assigned because it's very important. Once you do get assigned, what you want to do is you want to start selling call options. So let's just say that I got assigned, I have 100 shares. You go to sell call option, and you can also go from 1 to 6 weeks. So the expiration date for me is always 1 to 6 weeks. 6 weeks would be kind of like at most, and then 1 week would be, very short term. I'm not sure if that would be ideal because then it creates a lot of work for you. You have to keep closing out the option either manually or in the case of when you sell puts, you don't really mind to get assigned. But when it comes to covered calls here, when you start selling calls, you do want to manage it in an interesting way. And I'll explain that in just a moment. But, first of all, basically, you want to sell a call option that's out of the money. You can even go a little bit higher. So you can see right here, this is a little bit higher on the delta. That's perfectly fine because in 45 days right now, if I end up selling this option, right, the worst that can happen is I lose Palantir stock at $28. So given that the stock price is 26, that basically means I make $2 in upside, and then also make another $1.50 on premium. So that's like almost $3.50, okay, which is well over 10% return on the stock. So the thing is about the wheel strategy is not only does it give you a really good return, it's also really fairly low on the risk. So not much can happen. I mean, when you're running the wheel strategy and you sell a put option, worst that happens is you get assigned, you don't mind getting assigned because you like the stock, and then you turn around and just start selling covered calls, collecting income. So you start making income on the stock that you have. So it's just both ways you're collecting income. You're collecting income selling puts, and then you're collecting income on the covered calls. As long as you pick a good stock, and again, you stick to the rules of on selling puts, you sell a delta of, around 30. On covered calls, you can go way more aggressive because as you see here, the worst that can happen is you just end up losing the stock, but if you lose it at 28, that's not an issue since the current price is 26. So you're pretty much always going to be profitable on the wheel, especially on a long-term basis. Now, if the market crashes, many people will panic, but the truth of the matter is there's actually nothing to worry about as long as you're trading a good quality stock that is very likely to, recover. In most cases, since the market is rising over a long period of time, you can't really go wrong with the wheel strategy. All right, the next example I want to show you is going to be SPY. I personally have made a lot of money on SPY. It's very simple and it's very good for a retirement portfolio because so many people that are looking to retire, they don't want to put in too much work. They also want very low risk and they want to get compensated well with monthly income. SPY is that for you because specifically SPY is already diversified. You can see here they have many different sectors within SPY and it has a basket of 500 stocks. Now, obviously the top 10 stocks are very heavily weighted, like Apple, Microsoft, Nvidia, Amazon, Meta, Berkshire, Eli Lilly, Broadcom. These stocks have a very heavy weighting, but nonetheless, the rest of the 490 stocks that they hold add a lot of diversification. And this is a very cheap, expense ratio is 0.09. That means $9 you're paying in fees for every $10,000 invested. So, the fees are very, very low. It gives you diversification. And truly, I have some students of mine that are just making a full-time income on SPY. So if you want to run the SPY wheel strategy, it's actually very simple. You can go to sell put. Now I will say that SPY has different expiration dates. They have much more expiration dates. They actually have daily, so they have 1 day, 2 day, 3 day. Obviously it skips the weekend, but it has daily expirations, which means that it's extremely liquid. Like SPY is like the easiest thing to do a wheel strategy on. So I can go for something like 14 days out, and I can simply pick different expiration dates. So let me explain to you how I would pick. So if you go down to 515 right right here, you will see that the delta is 0.36. Now, you can actually play around with this yourself depending on how much risk you want to take. So let's just say you want to be very, very safe. You can go down and pick something that has a much lower delta. So let's go down to, let's say, 500, okay? So this has a 0.2 delta. That's going to be a lot lower than the 0.3 that I just mentioned on Palantir. So you can really pick your own delta. Now, there's not that many strikes here, and the reason for it is because August 20th is not going to be a traditional expiration. So a traditional expiration, for example, will be September 20. Now you can see here on September 20, there's going to be a whole lot more options to pick from. In fact, the options go way, way down all the way into the 300s. And probably, yeah, even in the 200s. I mean, in theory, you probably wouldn't want to do this because it would make no sense, but you can sell an option that's just super out of the money at 250. This is absolutely not going to happen, and this would still count as the wheel strategy, but you would make very low premium, so this would not be optimal. Optimal for me is, again, going to be around that 30 delta mark, but if you want extra safety and you just want to, like, you know, kind of like that retirement passive income strategy, then I would go for, you know, even 17 delta is reasonable. You can see here how the premium is actually pretty good at $513. So basically you can sell $513, and then when you do get assigned, or if you get assigned, if and when, right? Because at a 17 delta, you won't be assigned very often. I mean, in most cases, SPY won't even go down because by definition, a 17 delta means that there's a 17% chance of that happening. So there's an 83% chance that it won't happen. So basically 4 out of 5 times you're good. Like, you can relax. Now, even when it does go into the money, you don't need to panic. All you do is just kind of wait until the last day of expiration. You will be assigned. That will happen typically over the weekend. So typically on like Saturday morning or so, you get assigned. Obviously the market's closed, and then you basically have that position on Monday. So on Monday, what you do, as soon as the market opens, you basically start selling calls right away. I don't typically trade 9:30 a.m. in the morning on East Coast time. I typically wait 30 minutes as the market is already 30 minutes in, so I can get kind of a sense of direction for the day. And then I'll go for an option that, you know, I'll use technical analysis, all the things that I do cover in my Discord community. There's a lot of things I look for, but delta is one of the easiest to kind of just understand. So here I will basically, let's say I go for a delta of 530, you know, here I'll go 532. Delta, a higher one, I can sell this right here. You can now get a sense that basically I'm selling options to get in and I'm selling options to get out. Now, let's discuss how to properly manage the wheel strategy based on various scenarios. My Discord community has asked me before what to do if the stock, or SPY in this example, gets very low, much lower than your cost basis. This part gets complicated and nobody covers this. But here's scenario number 1. Let's say that the stock goes down 10%. So for example, you sell a $100 put option. It goes down to 90. Well, this is actually not that hard of a position. In this example, because the stock is now $90 and your average cost is 100, you can actually still try to sell 100 covered calls. Now, you likely won't be able to do that in one given week, because in 1 week, that's going to have no premium whatsoever, because option traders understand that since the stock is at 90, $100 is 11% away. Therefore, the premium will be very tiny. So what you will have to do is you'll have to sell covered calls that are 2, 3, or 4 weeks out at $100 strike price. Then you'll still be able to collect 1 or 2% premium while not really losing on the stock itself when it does recover. Now, in scenario number 2, let's say that the stock goes down 20%. This would be very insane and super unlikely for SPY. I mean, just downright nearly impossible for SPY to fall 20% in a week or two. So, you know, I do stick to weekly trading. So for it to fall 20%, really, that's probably not going to happen. But let's just say it's a different stock. So I know a lot of people like, you know, Tesla. You know, there's a bunch of stocks out there. And if the stock does end up going down 20%, let's go back to the example of a stock being worth 100, which is your put. It goes down to 80. Unfortunately, what you're going to have to do is wait and hope that the stock will recover. And hopefully, when you're selling puts and doing the wheel strategy, hopefully you're picking stocks that are good to begin with. Because if you're not, and the stock falls down 20%, you start scratching your head, why am I owning this thing? Well, you have to ask yourself, why did you get into that position to begin with? Okay, so if a stock goes down 20% and it's very far away from your cost basis, that's not necessarily that bad of a problem if you like the stock. What you're going to have to do is, number 1, you will probably have to wait. Or number 2, now this is very interesting. Say that the stock goes down to 80. You can try to salvage and create some income by selling a 90 covered call. So if you sell a 90 covered call, that's not ideal, because if the stock were to recover, you would lose some money on this position as a whole, and your wheel would not be profitable. But that's the price that you pay when you're doing the wheel strategy on a riskier stock. So if you're doing it on riskier stocks and it does end up falling 20%, what you probably have to do is you probably have to sell around the 90 strike price. However, it doesn't mean that you have to get rid of your shares at 90. What you can also do, say that you sell a 100 put, goes down to 80, you get assigned obviously, and then you start doing 90 covered calls. Say at expiration, or basically a day or two before, somewhere in that near to expiration time period, say that the stock goes up to $91 and you're upset. You're basically saying, hey, I don't want to lose these shares yet because my cost basis is 100. I did sell a 90 covered call. Let's say it was for $1. So technically you're breaking even at 91, but say you don't want to get rid of the shares. What you can do then is actually roll that covered call higher. So you can take that 90 covered call and close that 90 and then open up a 95. And in most cases, if you do that far out enough, you can still collect a credit or at least break even. But even if you break even, now at least you don't have to get rid of the stock at 90, you can get rid of it at 95. Now let's talk about the call side. If a call goes into the money, what will happen is you will get exercised and lose your shares in the wheel strategy, right? So you first of all can get assigned on the puts, you have to buy stock, but if you get assigned on the calls, you have to sell stock. So say you don't want to sell your shares. What you can do again is roll and close out that position. What is likely to happen most of the time is that someone will actually end up selling covered calls that are out of the money, and it's perfectly fine, because as long as it's out of the money, you're going to be collecting premium. If it's in the money, then you're gonna lose your stock if you wait until Friday expiration, or you can roll it out higher. There's two things that you can basically do. If you get assigned, so be it. If it's above your cost basis, you're probably happy. If you don't want to lose your shares and you are at a gain, that's okay too. Again, you can roll. Now, one important thing that I just want to say, with the wheel strategy, something that people do not realize is no matter which way, in which direction it's going, you can still dollar cost average and sell more put options or sell more covered calls by buying more shares, especially if it is below your strike price, especially if it is below your cost basis. So let me give you an example. For example, let's say that a stock is at 100, okay? You end up selling a 90 put option, okay? It goes down to 95. That doesn't mean that you can't sell more put options at 90. Let's say it goes down to 85. You can still sell more put options at 80. So you can continuously sell more put options the entire life cycle of running the wheel strategy, and that would be dollar cost averaging the wheel strategy. And there's nothing wrong with that. The only issue is, say you have $30,000 and you put $10,000 or $15,000 into Apple. Well, you can't really dollar cost more into Apple because it's already 50% of your portfolio. So when you are dollar cost averaging into the wheel strategy, you want to make sure that you have 5, 10, 15% of your entire money in a single position. Therefore, if it does go down, you can do more of the wheel strategy on the same stock, dollar cost averaging, but not exceeding like 30 or 40% of your portfolio. The less of your portfolio you have in one single position, the better, the more diversified you are. Now, it's very interesting because you can always roll and adjust the option wheel position. If you want to learn more about rolling, the best video you can watch is right here. Now, I want to cover some really important topics to understand the wheel, because this is an ultimate guide for you to really dial in your results, get the maximum profit, understand this on a deep level. So let's go over stock selection, and then as you saw, I'm going to cover volatility and much more. So stock selection, okay? First of all, quality stocks. Choose fundamentally strong, stable companies with good growth potential. Look for stocks with strong earnings, good cash flow, and a solid business model. This is what I'm doing in my Discord community. I am picking stocks for my members to basically follow along with me, because picking a strong company is honestly like 90% of the battle, because the wheel strategy will work on a good stock and the wheel strategy will not work if you pick a bad stock. So the quality of stock that you pick in stock selection is the most important thing. Now, quick word about dividend paying stocks. Stocks that pay dividends can provide additional income when you hold them. However, in the wheel strategy, when you are selling a put option, the dividend will hurt you. That's because typically when a company pays a dividend, the stock price falls by the amount of the dividend. But if you're doing a covered call and you already have shares, the dividend helps you because the stock falls, but you don't care since you're holding shares and your covered call is actually benefiting. Your covered call is benefiting because as the stock goes down, your covered call is basically farther out of the money. Now, don't get this confused because a wheel strategy is still bullish, so you don't want the stock to fall. But all I'm saying is if the stock does not reach your covered call strike price, that's fine because it's going to expire out of the money and then you can sell another call option. After talking about stock selection, I also want to talk about volatility because volatility is very important. You want to look for moderate volatility. Now, when I was working on Wall Street, I did listen to other traders that would say they love volatility. And for the most part, volatility benefits options. But volatility is specifically very good for both option buyers and option sellers when they have a clear direction. So if you're buying options, there's a lot of volatility. That's a good thing. And if the market is very volatile, option premiums are very high, so you can sell options profitably as well. But in terms of the wheel strategy, you don't really want too much volatility because too much volatility could actually be bad psychologically because you might want to roll, you might want to get out of the position, you might panic. But also, you don't necessarily want the stock to go up too much because in the wheel strategy, when you sell a covered call, you are limiting your upside. You don't have full upside. You have a little bit of opportunity cost. So if the stock ends up going through the roof, you're still going to have to get rid of the stock at the strike price of the covered call. So in a very bullish market, the wheel strategy is going to slightly underperform or even majorly outperform if the market goes up tremendously. So you're looking for moderate volatility in a slightly bullish market. You don't want it to be too bullish. And also, just to be honest, in a bearish market, you don't want to be invested at all. Obviously, if you can choose, you could time the market, you'd be in complete cash, but nobody can accurately do that. So the wheel strategy is still a very viable strategy in a bear market as well. So in terms of selecting stocks with moderate volatility, I would recommend, again, focusing on moderate volatility. So when you look at, Robinhood, you can just compare stocks and you can see for yourself that 30, 40, even 50 implied volatility will be good, okay? If it's just too high, then that's basically a very big red flag. That's a risk factor. High volatility can lead to a larger premium, but it also means a lot greater risk. So moderate volatility balances premium, income, and risk. So that's what I usually go for. Now, when looking at delta and moneyness, okay, I usually go for out of the money options. Guys, just out of the money options work a lot better, but I'll be honest with you, you can also aggressively run the wheel strategy by selling puts that are even in the money. You can sell a 52 delta put. I can show you what that actually looks like right now. So I can go for a stock, let's say Apple. Going to show you an example. You can sell an in-the-money put, and that would be really interesting. I have a really big position on Apple. Apple's been in a really tough spot lately, but I'm still up about 11%, $161,000. If I show you selling a put option on Apple, let's just say I'm going to go for a really short-term put option. You can see here how if I sell an in-the-money put, okay, this is in the money because if I sell a 210 put, Apple stock is below 210. You can see here how I'm collecting $4 and 210 minus 4 is basically 206. So I can get below the average cost right now. So at the very least, you should be using options to get a better price than what the stock is trading at right now. So this right here would be aggressively selling put options, and then you would be very high probability of getting a sign. Again, that's not a bad thing if you're bullish on the company. And overall, I do go for out of the money options. So here I would go for something like maybe even 202.5 because the delta is going to be right around that 0.3 mark, which I like. So this is 0.28 delta, just a little bit lower than what I like, but that's perfectly fine. It's not necessarily better or worse. The volume here is insane. So much volume, short-term expiration, right? Again, if you're watching this in the future, just use the same logic, the same thought process to implement this strategy for yourself on any stock, really. So if I were to sell this, you can see how I'm going to get paid $144. So you can go for in the money options or out of the money options. Personally would tell you that out of the money options are just way more profitable, but when you're running the wheel strategy, it is a profitable strategy as a whole. So you can go for 50 delta or even just a little bit higher. I wouldn't go too crazy with high deltas though. Now, as a rule of thumb, I said that short to medium term expiration is going to be the most profitable. Typically 30 to 40 days expiration is a very good range for me. Gives you basically the most optimal returns without having to do too much work. This time frame balances premium decay, which is basically that theta that you see on options, all right, and time risk, okay? So for example, this option right here has a 0.48 theta, which essentially means that every single day you're making about 48 cents. Nothing crazy right now. So this theta right here basically means that you're making about $48 per day. And that's a pretty high amount, and that's because there's 3 days left. The option's $144, and the theta is really, really kicking in, so there's a lot of theta. That means if Apple goes sideways, goes a little bit up, a little bit down, the theta is going to still eat away at this option, okay? The theta right here is going to eat away at this option 100% in the next 3 days if Apple is not below 202.5. So as long as Apple kind of hovers around these levels, the theta is going to completely eat up this option, which is a good thing for you. If you are selling options, then you get this money right now, and as it decays and goes down to zero or close to zero, you can actually think about closing out this option. You can wait until expiration, or on the day of expiration, let's say that the option is getting kind of close to 202.5, you're a little bit worried, and you've made, let's say, most of the option premium, like 80%, you might decide for yourself, hey, I'm just going to close it out and take profits. There's nothing wrong with taking profits, but I personally myself have noticed that I get a bigger return when I basically just wait until expiration, just let the option expire. But I do have many students that when they see a 50% profit, they will close out the option, pat themselves on the back, and just kind of be happy with it and, just trade something else. And I think that's perfectly fine. I just want you to understand also risk management, all right? Risk management is probably the most important thing. Now, luckily with the wheel strategy, there's not that much risk, so there's not a whole lot of risk management, but I'm still gonna cover this as a whole. You need to understand risk management in 3 different steps, okay? The first one is capital allocation. Allocate your capital wisely, basically to avoid overexposure to any single stock, all right? So when you're running the wheel strategy, it's a good strategy, but it doesn't mean that you can put 50% of your money in a single stock and just run the wheel strategy on that stock, okay? I like PLTR a lot. I talk about PLTR on this channel. I've been right about it, made a ton of money, but you don't see me putting 50% of my money in PLTR and running the wheel strategy, because that is just a little bit too aggressive. You want to stick to some proper allocation, maybe 10% of your portfolio at most, unless it's a really big cap stock like Apple. Then Apple breaks rules. Absolutely. Microsoft, Amazon, all these stocks can break rules. And even in that case, Magnificent Seven, you're still taking a risk if you're over leveraging into one stock. So you need diversity. You need to diversify across multiple stocks and ideally sectors. You want to diversify risk amongst different sectors. So what I mean by that is you don't want to just be invested in technology. You want to also have healthcare. You want to have consumer stocks. You want to have everything. Okay. So when you're running the wheel strategy, keep in mind you want to have 5 different stocks at least that you're running the wheel strategy on. You don't want to just have one in your portfolio. Now, in terms of risk management, using stop losses, I get this question quite a lot in my community, but a lot of us have been super successful. A majority of us have been making, just consistent income. And I'll just be honest with you, I don't personally use stop losses. I think stop losses are very dangerous. And, when you use a stop loss, essentially, sometimes it stops you out at the wrong time and ends up doing more harm than good. Now, in terms of market conditions, bullish to neutral markets are going to be the best for running the wheel strategy. The wheel strategy works best in bullish to neutral markets where stocks are not expected to decline significantly. Again, if you're in a bear market, the wheel strategy can work, but you're going to want to lower your deltas. So when you're selling put options, you definitely want to sell 20 delta put options, especially with this volatility right now in the market. You're going to want to sell puts at a 20 delta or even 15 delta when the VIX is very high. So I do pay very close attention to the VIX. The higher the VIX, the more uncertainty there is. Now that is a double-edged sword, because from one perspective, you are making more money when you're selling options. But on the other hand, if the market ends up declining, the wheel strategy will be hurt. So there's a lot that you can do in terms of rolling down a put option. However, I will say that I typically don't do that unless you're in a bear market.